Oh man, FOMC day. Is today going to be the moment within the next 10 minutes that we officially get that pivot? This will be the first meaningful piece of action we've gotten since we've started this tightening cycle. Remember, we've been on a whole year of 2022 with the government, with the FOMC against us, hoovering up money from this economy, becoming more and more aggressive with their rate hikes. Is this the moment that we don't get a U-turn? That's coming. But just get that little bit of a slowing down that shows they're packing less of a punch. They're not going to do 75 basis points. And are we going to see that 50 basis points? We've got 9 minutes here before that. We're going to cover it off. I'm going to show you a split screen view. We will have the charts up. We will have Jerome Powell's press conference as well. It's important to understand that it's not just the rate hike. It's the press conference which we get after the rate hike. So there will be the rate hike. We'll get a summary of economic projections, which we don't get with every release. This is going to be important. I'm going to walk you through that shortly. And then you're going to get the Jerome Powell press conference. And I think more weighting is going to be placed on the Jerome Powell press conference. So thank you so much, guys, for joining me. Let's see who we've got here in the chat today with us. And there's a bunch of you in here. I can see Andrew, smash the likes, absolutely. Barney, we can see you. Gareth, we can see Tufel, Omar, Nabil. Good to see a bunch of you. Barney, good to see you. Rod, good to see you. Liam, good to see you as well, buddy. Awesome, cool. So we're packed in here, ready to go, guys. Make sure you smash up likes so more people see this live stream. You guys are dedicated because obviously in the next 8 minutes, you've got France versus Morocco in the World Cup semi-final. I've put a little contingency in place so we can have the score up at the same time as well, so you're not missing out on what's happening, but we will catch the second half, so not to worry about that. We've got to take care of our investments first. So let's get straight into what the markets are doing. And the markets, first and foremost, in terms of the US traditional markets, have been a little bit tentative today. We're starting to see it pick up a little bit, as you tend to do before Jerome Powell speaks. So now sitting at 0.7 on the NASDAQ, S&P 0.7 up as well. Bitcoin, on the other hand, is an absolute rocket ship right now, breaking to the upside of this rising wedge, 18,300. And this is really good news for me. Remember, I wanted to recoup this 17,600 level, not just because a lot of people were saying, oh, we're going to get rejected from that level, but also because that was the June low. That's the low where we picked up support dating back. So I'm really happy that we haven't just got rejected from there and we're able to push above there. Now I want to see us get back into the channel, 18,800, and today could be the catalyst for that. If we can get back into the channel, this is the channel from before FTX collapsed, so it can show, it's quite a symbolic level. It will show that we're pretty much through it and we're feeling a lot more confident now. We're back at those pre-levels. Let's remind ourselves on what we're expecting. We're expecting, well, 83% of the market now is expecting a 50 basis point rate hike. Remember, it'll be our first one in a long time. We've had 75 basis points, 4 in a row. And not only will this indicate that we've got 50 basis points, but now the markets will start to think ahead. The market's going to think ahead to, oh, well, if we get 50 basis points now, what about in Feb? Maybe we can have 25 basis points. If things go well, maybe in March or maybe in May, we'll get a pause. We'll get 0 basis points. Right? And then maybe in June or at some point in mid-2023, we can start having rate cuts and we can start turning back into a money printing environment, right? A more accommodative environment. This is why there's so much excitement right now, and this is why it's having such a big impact on the markets. Now, also, very quickly, I'm rushing because we've only got 6 minutes, guys. I need to fill you in on what we're expecting. I want you guys to focus on something called the Fed funds rate. And that is, where are we going to hike to? Because remember, right now, everybody's focused on how much are we hiking? Are we hiking 75 basis points? Are we hiking 50 basis points? But nobody's thinking about what that final Fed funds rate is going to be. And that's what we need to refocus on, is what is that? And if I scoot down here to the 13th of December 23, which is the December 2023 meeting at the end of next year, you can see that the vast portion of the market here, you can see, are between that 4 mark and the 5 mark here, okay? And if you want to take the vast majority, are sitting between 4.25 and the 4.75 in terms of where we're going to hike to. Now, in the summary of economic projections, we're going to get another clue of where we think that number could sit. Okay, let me just remind you what that looks like. Let's pull it up on the iPad. And this is the last summary of economic projections we had. And if you look at that number in the middle there, I want you to focus on the 4.6. That is your Fed funds projection for the end of 2023. They revised it. In June, it was sitting at 3.8. They revised it up to 4.6. And now I would expect that to be revised up to as high as about 4.8, okay? So some of the markets will be expecting that to be as high as 4.8 today. Now, Others, there are some rumors saying this could be 5%, 5.25%. And that is what markets could be spooked upon. So don't just jump on the 50 basis points and say everything is okay. We're going to have to take 5 to 10 minutes to dive into the numbers to understand what's going on. We also need to look at the dot plot. Remember, you get something like this as well. Let me flick down to it. This is called a dot plot. I know it's boring for people in crypto. I know you rather watch the football, but the reality is this is going to tell us if all the FOMC participants, the officials, are on the same page. And if we get a bunch of dots up in this range, in the 6th level, that could be quite worrying for markets. Because if you look at the last one, nobody expected beyond 5. See that line there where 5 is? Nobody expected beyond 5. So if we do start to see that, that could show that we've got some skew, but we will walk through that together. So don't worry, guys, you will not be doing that alone. Cool. So we know what to expect. We know what can move the markets. I've gone ahead and put us a split view here so we can see Bitcoin on the left and S&P on the right as we move into it. Let's see what you guys are saying. Cool. Had to wrap that up really quick. We've got 4 minutes to go. Ross Chapman, my man, let's go. Hope you're all, buddy. Good to see you in here as always. DJen says, love the show. Awesome. Oh, man, appreciate you. DJen says, love to have you on my show. Absolutely, let's make it happen. Nabil Kayani, 50 basis points easily. Yep, I think you're right. Look, most people expected 50 basis points. Let's talk about the shock. The shock would be, do we get 25 basis points? Wow, markets would just skyrocket. I don't think it's going to happen, but, I've got to give you the scenarios. What if we see 75 basis points? Market's going to tank. Okay, the markets have not priced in those scenarios. The scenarios which haven't been priced in are what moves the markets. Markets have priced in 50 basis points. So don't expect to see, a rocket ship as soon as we get 50 basis points. I expect a little bit of a rally. I don't expect a rocket ship. Where the rocket ship can happen is if Jerome Powell comes out and talks dovish like he did a couple of weeks ago. But my premonition is if he does 50 basis points, he might give with one hand and take with the other. Right? So he might give you 50 basis points, but maybe he talks a bit strict just to say, guys, we've still got work to do. Labor market's still there. We've got to bring inflation down to our target rate of 2%. There's still a lot of inflation there. He could just do that just to remain hawkish, to stop euphoria in the markets. He doesn't want the markets to run. Okay? And that's the point we need to understand here. Maximi, good to see you. Hope you are well. Special K, good to see you. 50 basis points, neutral to hawkish speech. Continued hikes. Christian, S&P 500 has hit resistance at 4K. One bad event and we're happening to like 3,700. Steve, good to see you, buddy. He says 50 basis points for sure. I think you're absolutely right. Tufel, what's up with the Binance FUD? I made a video about that. Go watch that. And again, I don't think it's FUD. I think it's fair that people are spreading some information and trying to test Binance. No harm in doing that. So that shouldn't be an issue as well. Right, 2 minutes before we go. As you can see, guys, I've put a little thing in place as well so you guys can see the score. You can see the starting lineups showing as well if you're interested in the football. I'll flick this up occasionally so you guys can see what is happening if you're interested in the football. And we'll also pull up Jerome Powell like this. So we'll have Jerome Powell there when he's doing his press conference in that segment as well. So we got all things sorted. I've tested it all for you guys. It's working. And now we are 2 minutes away from seeing if we get that rate hike. Now, guys, you're going to have to watch this with me, right? So the rate hike, in order to get 50 basis points, that means the Fed funds rate will be changed to 4.25 to 4.5, okay? So when we open up the report, when we're going to see it here, we'll refresh, we'll get the PDF here, we'll open it up together, and we should see that the target rate has moved to 4.25 to 4.5. Anything different, we've got a little bit of a problem in either a good way or a bad way. Remember, if we see 4.5 to 4.75, he's gone ahead and done 75 basis points, okay? Most people are expecting 50 basis points. That should be where we're at. You can see Bitcoin is absolutely loving it, up 2.3% today, sitting quite comfortably above 18,000 and now waiting for direction post this FOMC meeting. Christian says, I pray it's 75 basis points. I'm assuming you've got some more buying to do. Rusty says, when moon? Potentially today, guys. Mitto, hi Ijaz, good to see you. One step, have the markets pricing the inverted yield curve? No, potentially not. Cool. I think we've covered off everybody's questions there. Does 50 basis points means we definitely bottom? Absolutely not. And this is an important point. Whilst we are starting to, I don't want to get distracted. Let's just quickly refresh. Let's make sure you've not missed it here. Okay, we got it. We got it open. Let's open this PDF. December 4.25 to 4.5. We've got 25 basis points. Great stuff. Let's see how we're moving. We've got the 50 basis points and the market is now falling. They're hoping for a little bit more, it seems here. We're going to have to take a look at the summary of economic projections. Allow me to get that up. whilst you guys are doing that, we need to pull up the summary of economic projections to understand what was in there. Because remember, some people get early releases, so we want to see what happened here. Let's pull that up here, and we will go to it right here. Summary of economic projections, and there. So the terminal rate has gone up to 5.1, a little bit higher than we would have wanted, guys. So this is what I'm talking about. It's gone from 4.6 to 5.1. So in essence, what they've done is they've given with one hand. They said, look, you can have 50 basis points, but we think we're going to rate hike for longer. So they've just put it on the back end. So if you imagine, if I say, oh, look, I'm going to lend you less money, but you owe me less money, but I'm going to put it at the end of your term, it's not quite the same as me saying I'm not going to take that money off you. I'm just saying I'm going to take it off at the end. So that's what they've done. They've taken that 50 basis points and they've put an extra 50 basis points at the end. Previously, in September, they were projecting to hike all the way up to 4.6. Now they're hiking all the way up to 5.1, okay? And we can see that markets are not happy right now, spilling up a little bit. Let's take a look at the dot plot. Yeah, and there you go, guys. Exactly what we said. You've got a couple of dissidents at the top here. In fact, here you've got a lot. Right? If you look at 2023, a lot of these Fed members, this is going to spook the markets, guys. This is going to spook the markets. Hopefully you can all hear me clearly. Let me know if you're having any issues as I'm facing the iPad. But this is going to spook the markets. Markets will not be happy with this many Fed officials expecting more than 5 basis points and some close to 6. Okay, so this is what's going to be affecting the markets. And you can see here, particularly in 2024, remember, this is called a scatter plot. This scatter plot is very scattered, okay? So the Fed officials are not aligned in what they're expecting. And this is a little bit of a worry here because some are saying we want to go as high as 5.75 up there and some are as low as 3% in 2024, okay? So this is showing a little bit of a mixed bag here with many Fed officials thinking we could still be at high rates, not just hiking to a higher number, but staying there for longer as well. Let's also take a look at the other figures that they provide as well. Changing to real GDP 0.5, expected that it's not too much of an issue. PCE inflation 5.6, that's not too much of an issue. The bigger issue is this, guys. It's the 5.1, but also this number here, which this has gone up to 5.1 to 5.4. In other words, a bunch of people in the FOMC camp are expecting higher figures at 5.4. So that's what's spooking the markets a little bit. Let's head back on over to the S&P to see what we've got going on here. So you can see here, Bitcoin is falling back under 18,000, 17,800, giving up a lot of those gains there. S&P is puking as well. And this is what happens. You can get 50 basis points on the one side, but at the same time, he's taken from the other hand. This is why I said, guys, this is why I kept trying to fly the warning that it's not just about the rate hike. There's a lot more going on here that markets want to understand the nuances. Let's see what they're saying over at
the outlook
Bloomberg
for next year for real GDP. That forecast for 23 is now only 0.5%. The September projection was 1.2. If you're looking at unemployment, they've now got that at 4.6 from 4.4. And PCE inflation, and I think this speaks to the move you're seeing in the dot plot for next year. Lisa, they now see PCE inflation for next year, 23 at 3.1 from 2.8.
I don't understand why the reaction in markets isn't bigger. I mean, the knee-jerk reaction, this is a hawkish Fed after a lot of people were talking about more nuance. There is no nuance here. This is very clearly a hawkish Fed that would like to keep rates above 5% for a lot of next year. That is a very different message than what the market has been telling us.
Can I go to a quote from Alan Ruskin at Deutsche Bank from yesterday? Alan, coming into this, said this: the market will probably also take the Fed's higher-end 23 dot as a way of the Fed trying to signal that they do not expect to cut rates in 2023, something the market will continue to view with skepticism. Now, Tom, this can, of course, change.
Well, this goes
in the news conference in 26 minutes, but are we seeing that element of skepticism push back against what the Fed's trying to signal?
I defer to Professor Claret on this and Dr. Dudley of Berkeley. It's real simple. Is there any precedent of a central bank doing what the market's analyzing right now? We made a joke 4 days ago about a hat trick of pivots. I think we were talking about pivot one, pivot two.
It's a three-part story.
Yeah, it's a three-part story.
You step down first, and then you pause, and then you cut. And clearly, they're focused on the step down, never mind the pause, and certainly not the cut. I'll say what I said last time around. These are the moves on the screen at the moment. Let's wait for the news conference and see how Chairman Powell communicates.
Totally agree.
But I'd also say, yes, that dot plot has shifted, but they've been signalling that now, Lisa, for the best part of a month.
And people have been rejecting it, and they continue to reject that. And again, you could say what you want to say, and you could say, what are they going to signal in the press conference? But because of the game theory that you're talking about, people are shrugging their shoulders. They're not taking it as seriously as you would think.
Equities down, Tom, by 0.2% on the S&P.
Well,
on the Nasdaq, down by 0.4%. Just to breathe some life into the market action elsewhere. Yields now higher on the session, just a little bit at the front end on a 2-year, by about a basis point to 423.
So exactly as we were expecting there, guys, markets have been rug pulled here by the Fed. I mean, they've given with one hand and they've taken with the other. And you can see markets are starting to now digest this. We will stay tuned for the press conference because the press conference is where it's going to come. And this is why, guys, I know it's boring when you're in crypto. You want to go watch your football. You want to just trade a bunch of things and get excited. You've got to understand the nuances, guys. And the only reason I know this, I'm not acting that I'm super smart. I only know this because I spend time in traditional finance. I know these kind of tricks and how they move the market. So, guys, make sure you subscribe to this channel. Make sure you hit up the like button so more people can join us on this live stream. Again, consider checking out my free TA course, ijaz.uk/TA. Not here to sell you that. That's completely free. Links in the description. Learn all the TA stuff. Learn it. Go learn it. It's completely free. This is 10 years plus of traditional finance experience I've put into one course for you guys. Let's see what else you guys are saying. Gareth Jones says, I'll be back for the press conference. Where are we heading BTC now then? Dropping out of the channels. Well, guess I can get on ETH for way cheaper now. Yes, so let's get back onto where we could be expecting us to go. So we've got to hold tight because Jerome Powell's got to come and explain. But this could mean two things. One, a retest at 17,600. I want to see how strong is this? Is it an important support level? Can we bounce here? That'll be fantastic. Otherwise, depending on what Jerome Powell says, the next support is down here at 16,240. So those are our kind of key levels, but hopefully we can just build some support. Look, at the end of the day, we've got 50 basis points. Yes, the market isn't too excited that we've had to put this at the back end, that we're going to rate hike for longer to a higher Fed funds rate. But the markets will understand that. I don't think anybody in their right mind didn't expect that. That was more likely than not to happen. Oh man, we've got an update on the football, guys. So as you can see, France have gone ahead and scored after 5 minutes. The first goal gone in as we've been covering the FOMC meeting. So you guys can read that while that's there. Halim, hello Ijaz, I just got home. What happened? 50 basis points, guys. It's 50 basis points. But probably loads of people jump in and say, what's going on? Why have we had some red? And the reason is markets just had to digest the summary of economic projections, okay? And in the summary of economic projections, we just covered it off. You can rewind back. They've increased the Fed funds rate, the projection for the end of 2023. They've increased that to 5.1 from 4.6. And also the dot plot is really scattered, and that's causing a little bit of concern for markets as well, okay? So it's a dot plot scattered, which is showing that some Fed officials want to hike well into the 5%. Remember, previously, we were planning to stop at about 4.6, and now we're getting a bunch of people saying we should be hiking well beyond then. So let's see what Bloomberg's saying.
The stock market's up substantially. Rates are down meaningfully. And so, the Fed, I think, felt that it needs to lean into that because it doesn't want, the economy to pick up momentum again and, prolong the inflation problem.
So we're getting a bit of a move at the front end by 5 basis points now to 427. If you just go through the details of the projections, typically when we break this down, we look at the median. I'd say shift along the SCP, the summary of economic projections, and look at the range for 23, just the range of estimates, 4.9 to 5.6. I have to say here, Scott, 4.9 to 5.6 probably wouldn't be the range I expected. Are you surprised by how tightly bunched these Fed officials still are looking out to 23?
I'm not surprised in 23. What I was surprised is how big the dispersion is as we get out further.
3.1 to 5.6 in 24.
Right. I mean, John, what really is striking to me is no one is saying that there's any likelihood that they would possibly cut rates in the second half of the year. And I think, the market is obviously starting to discount that. So, the slowdown in the economy and all the inflation data that we're getting that is showing that deflation is decelerating rapidly, and some parts of the economy are falling into deflation, they're completely discounting based upon wage growth. And I candidly, when I was an advisor to the Fed 5 years ago, the whole discussion was.
Okay, so I do want to spend a little bit of time explaining a little bit of this. So let's just jump back over to the summary of economic projections. Let's pop me there. Now, what you're seeing here on the dot plot is that what the Fed officials are saying just look at the median, right? And if you look at where the majority of people, the biggest line, so in this case here, right, obvious, and then you've got this line here up there. And if you look at that one, what they're saying is we're not going to reduce rates until 2024. Okay, so you've got the vast majority of people thinking we're going to go well into the fives and we're not going to get that rotation down in 2023. This is what's causing part of the concern here in the markets, because markets, like you and I, were thinking, okay, maybe we get 50 basis points, then at some point in the next meeting or the meeting after, 25 basis points, and then in the meeting or the meeting after, somewhere in the mid of next year, we could get a rate cut. But there's not... we're not seeing that from what the Fed officials are saying. So we're going to need some clarity on that from Jerome Powell when he comes on over to speak. So that's what the markets are going to be looking for. You see the S&P falling below 400 now. You see Bitcoin trying to stem the bleeding here at just under 18,000, 17,900. Let's see if we can manage to quell that bleeding there. Again, we've got to wait for Jerome Powell in the next 19 minutes. We will be covering that off as well. France 1-0 up against Morocco. Really early goal there. Worst possible start for Morocco for those supporting. Okay, so let's now jump on over to, let's see what we're seeing on here. And what I want to show you is this is where we could be falling, right? So you want to be looking out for, do we need to hold support at 17,006, or are we going to lose that level? If we lose that level, there's not much support then until you start falling down to that 16,200 level. So we're going to need Jerome Powell to come in and save the day a little bit here. Hopefully Jerome Powell's looking at the markets as we speak. He's always got a 20-minute gap to kind of get a hold of, okay, how are the markets responding? Do I need to soft talk the markets, or can I be a little bit more rough? And right now, I think he needs to come and explain what's going on, because now the markets are not going to be happy. Markets are going to think, okay, we're not going to get a rate cut in 2023. And that's what's causing a bunch of this concern. Let's see what questions you guys have in the chats. Feel free to smash up the likes, guys. There's a bunch of you have not hit up the like. Please hit up the like, guys. Really helps this channel. Means more people can find this stream and see this type of content. Hopefully you guys can do that for me. Doesn't cost you a penny. And if the content gets worse, you can just unlike it. Yeah, it's reversible. Fantasco says, change the channel name to Magic A1 Crypto. Yeah, I could do. I should change the name, to be honest, to something a little bit more catchy. Christotopia, when you say markets, generally speaking, are we referring to institutions or retail? As far as I know, most institutions are sidelined until risk-off environment. Both. Markets is everybody. It's not that everybody is trading on or off. People just do different things, right? SRK says, why market dump? Reverse back, guys. Just take the red thing and go back here on the YouTube video and catch up on what happened. We've covered that all off. Toga says, need to be watching what will happen with Grayscale. Special Case says, hit the like. Absolutely. Raj wants ETH below 1,000. Got a little bit of way to go there. I mean, something pretty worse needs to happen for that to happen. Hassan says, what's going on? We've had 50 basis points, guys. We've had a little bit of rug pull by the Fed, who have decided that we're not going to see a rate cut pretty much. I mean, we've seen a scattered dot plot. We saw an increase in the projection for the Fed funds rate from 4.6 to 5.1, which is basically saying that, look, we're going to rate hike less. We've gone from 75 basis points to 50 basis points, but we're just going to rate hike for longer. So it's like, even if they go down to 25 basis point rate hike, they're just saying we're just going to do more of them. So, really, it's two twos and a four, right? It's the same thing. And that's why markets are like, okay, fine, you've given us with one hand and you've taken from the other. So it's a little bit of a rug pull here by the Fed. Jerome Powell's going to have to come out and kind of explain some of this to see what happens. Carlos is saying, dump it. What's up? Hope you're well, buddy. A lot of people are happy, right? A lot of people remember, this could have easily been a day where we went up to 19,000 and you would have been missing the purchases. So now again, you get to opportunity under 18,000. You've got to ask yourself, guys, what am I doing? What's my conviction? Do I need to buy some more? Because this market will move quickly. Trust me, this market will move quickly, and you're going to wish you accumulated at the levels. Keep the football up there for some of you who are asking. Let's see what other questions you guys have. Vision Extra says, love the stream. Appreciate you, buddy. Dixie is flying. Yeah, good point. Let's take a quick look at the Dixie. Remember, dollar index is inversely correlated, and that's what happens, right? So you get this let's move this out of the way, the football score. dollar index is inversely correlated. So this is what happens. A big move in the dollar index means bad for risk on stocks and assets such as crypto. And that is why we're seeing a move to the downside. So this is dollar index getting a little bit of a rally here on the hourly chart. Again, this is small movements, right? Obviously, this is going to affect the traders, but we've got to take a look at this more holistically. So don't panic just yet. We're sitting here. We've had a little bit of dump after the announcement. That's completely fine. But let's consolidate. Remember, the main moves come when Jerome Powell speaks. This is just the first statement. The statement's done. We've absorbed it. We're still sitting at 17,900. Yes, we lost a little bit. But all that happens is before the meeting, you get a bunch of foam. It's just traders. I'll show you this. Look, let's just jump over here to the hourly. All this was here was just a bunch of traders running this bit up. The normal price we were at pretty much is where we're at. Right? This level here where you got rejected at 17,900 is the normal base level going into the FOMC meeting. Then you had traders bid it up. The traders bid it up, and then when the reading came out, it's just dumped. So you ignore that. We're just back here to where we were. Now we sit 17,900. Now we absorb to see what happens here from Jerome Powell and what they say. But ultimately, the bit I'm not happy with is what we expected. Like I said before the stream started, I thought the Fed funds rate would go up. The projection will go up from 4.6 to about 4.8. It's gone up to 5.1. Yes, it could have been worse. It could have been 5.2, 5.3, but 5.1 is pretty tricky to say the least. And also, if we then just take a look at the dot plot to show that how scattered those Fed officials are, that's going to be a cause for concern as well. I mean, if we just climb back to that so we can show you guys, this is what I'm talking about. This is going to be a concern as well, that they're so disjointed, and some really want to see some, levels up there at 5.75 as a terminal rate. And remember, these are just human beings, and they can have some sway. And that's what moves the markets. A couple of these Fed officials can easily sway the rest of them over the next few months and into next year to start convincing them to move their dots higher as well, for them to start believing in a higher rate hike as well. Okay, so that's affecting markets along with this number here, the 5.1. So for those of you who aren't familiar with the summary of economic projections, this is exactly why I wanted to explain that before the stream, so everybody understands. A lot of people trying to take this on very surface level. Oh, it's going to be 50 basis points. Nobody cared about the 50 basis points because it was already priced in. That's why I kept saying that. If it's already priced in, it's irrelevant, isn't it? If it's already priced in, nobody cares. It's only what's not priced in that the markets react to. So it's what Jerome Powell says next. It's impossible to price in because nobody knows what he's going to say. So that can naturally move markets as well. Let's go ahead and see if Bloomberg is saying anything interesting.
Once we get through this seasonal rally that we're living with, and the relief rally that we got from the last meeting 6 weeks ago, I think that we...
Can you guys let me know if you could hear the Bloomberg, the volume's okay? Let me know if it's okay here on Bloomberg.
The seasonal rally that we're seeing right now, what would it do to this economy if rates were held at 5.1% for the bulk of next year?
I think it would probably put us into a pretty severe recession. At least I have to say that one thing that I am always driven by historic data. Tom can speak to that. And the one piece of historic data that I can hang my hat on here is the Fed has consistently been wrong in its projections. So I think that
can you sugarcoat that, please, Scott? I mean, can you be less direct? Thank you.
I think that if we actually had the outcome of 5.1%, as the Fed is saying, then we would probably push the economy into a pretty severe recession because as inflation falls off, that becomes a highly restrictive monetary policy.
Hey, this is the debate right now, the tension between what this Fed is trying to signal and what people believe is achievable. And Tom, between people like Scott and this Federal Reserve, there's a bit of a spread at the moment, that's for sure.
The eclecticism of our guests and their different opinions, I'm going to go to, this is something that Neil Dudd has talked about and Michael Darda at MKM Partners, and you hear me talk about it, John. We are so wedded to a real analysis, an inflation-adjusted analysis, including your wonderful show, The Real Yield. And the answer is there's a nominal analysis as well. Mr. Duda does that after this
strong nominal growth
decision where you get some growthiness maybe in GDP, but far more inflation stays sustained and unemployment doesn't move. And all of a sudden, you've got an animal spirit built in, 70s-like, and they can't cut rates as so many people are expecting.
That's the challenge for 23. Live from New York City this morning, or rather this afternoon.
Just to recap, guys, we did get a 50 basis point rate hike, but the market's getting I mean, you can almost say the market's getting a little bit greedy now. So the market is trying to understand, when are we going to get that rate cut? Remember, markets want to think ahead. They don't care about, 50 basis points was priced in, it's done. They're thinking about what's next. When can we get that rate cut? That's when the euphoria is going to come, right? You go from hoovering money to the first rate cut. That is the first U-turn from the Fed. So we've had our pivot. We've gone from 75 basis points to 50 basis points. Let's tick that off. Let's celebrate it. But the market doesn't want to celebrate it. Market now wants to move on to say, okay, we've priced that in over the last week or two. We knew you were going to do 50 basis points, mate. Why are you getting excited? That's the whole reason we're at where we're at. Now we want to see what's next. Are you going to talk about 25 basis points? Are you going to talk about when you're going to pause? What's the terminal rate? And so far, the summary of economic projections, the PDF document which we just went through, showed us that that could be a little bit more troublesome than we initially thought, because a bunch of those Fed officials are starting to think that we need to go well into the fives as a terminal rate, whereas previously it was sitting at 4.6 at the last reading on September. Hopefully that makes sense. Let me know in the chat if that doesn't make sense, if you need any clarity on any of that. But that is what we're seeing here in the market. It's hugely frustrating, but Jerome Powell is giving with one hand and rug pulling with the other. We shouldn't be too surprised, should we? Billy says, a long, steady growth works great for me. Pumps are not healthy. I agree. I always like that concept as well. Big pumps just mean big dumps, right? If you can build slowly with scaffolding, build support, get to the next level, build support, that's always far better for the long run. Completely agree with that mindset. Wakas, is there something in the rumor that the employment numbers are not 100% accurate? Fed trying to increase borrowing during very slow market period during, we don't know, right? I mean, this is always the argument some people call CPI reading CPI. At the end of the day, we've got to take a data with a pinch of salt. We've got to look at the data that's coming in, and to the extent that we look at the data is just because it informs policy. So if Jerome Powell's using that data and where to believe it, he's going to make his decision off that policy. So it's not really that we care exactly what that number is. It just means, what is Jerome Powell going to do? And that's what we need to focus on here. Uptown saying, why didn't the VIX move? The VIX generally is just volatility index, right? So it moves when you see massive volatility. So I've not looked at it, I've not got it up here, but I'm suspect it would have moved in the build-up and then it'll move again during the press conference. That typically tends to be what happens. Squirrel, good to see you, buddy. Golden Surfer, good to see you. Rate cut, haha, long way ahead. Stupid to even want to hear about that. I agree. It's a long way into the future, but markets, that's what markets do. Markets play the long game. Markets couldn't care less about what happens today. They're trying to think on a horizon of at least 6 months normally. Uptown Dunk says, recessions usually happen after the Fed pivots. Yes. Workboy says, what is the 4.6 to 5.1 called? It's the Fed funds rate projection. It's their projection for what the Fed funds rate will be, the terminal rate. AT, great content, great channel. Appreciate you, buddy. Really kind of you. Please do support by hitting up that like button. A bunch of you guys haven't hit the like button. There's a bunch of you in here, but the like button has not been smashed. Smash a button. Share this stream with a friend, guys. We're going to be on covering the press conference, so we've got 6 minutes or so until that. Share the link with a friend. Get them on to watch the press conference with us. France are winning anyway, and we might as well watch Jerome Powell bore us instead. So definitely get them plugged over. Let's see if he can make any sense of this and whether he can speak dovish to us, in which case markets will react, or whether he's going to come out quite bullish, quite hawkish, and drive the markets even further down. Could he possibly do that? Remember, Bitcoin's still up 0.6% here on the day. Not ideal, because a lot of people were expecting we'd be able to push in towards 18,800 and beyond. But look, we've got 50 basis points. Let's celebrate what we've had. We've had a pivot. Yes, we priced it in, but it's actually happened. Guys, it's great news, right? So now in the history books, 75 basis points 4 times and a 50 basis points. Now let's progress towards our next 25 basis points. Let's take it step by step. And we as investors just need to do what we need to do at each of those points. If Bitcoin dumps, I continue to buy some more. I'm not buying at these levels, but if we fall further lower, I will be nibbling some more, right? And that's just the game plan that I've got. So for me, if you guys are interested, for me, it'd have to fall well below 17,600 for me to be getting nibbling again, and particularly closer to this 16,240 line here. This support line here at 16,200 is particularly where I'd be more interested in nibbling some more Bitcoin for long-term holds as well. Again, just a reminder for all of you guys, yes, there's funds circulating around Binance and you know, it can get quite scary. I know a lot of you guys hold funds on Binance. I did say to our members on our course member live streams, which by the way, if you want to join ijaz.uk/member, we do 3 times weekly live streams where you guys can ask me questions and know what I'm doing in the market, TA, fundamental analysis, tokenomics, etc. But I said in there, guys, just be careful, learn how to get your money off Binance and start rotating some of that out there. Don't trust that any exchange is bigger that is, you know, is possible to survive. Any of those can go down. Don't put anyone on a pedestal, not even CZ. And look, they're going to be fine. I think they'll be fine. But I also thought that for FTX as well, right? You think that for a lot of these exchanges, but you can't, you know, don't wait to find out. There's no need to wait to find out. So why wait to find out? It's not a risk you need to take. Go into learn how to store onto cold storage, take self-custody, onto a ledger, onto a nano. If you're a bit nervous doing that, try a Trust Wallet or a MetaMask, and at least you can learn to take self-custody. Start with a small amount, just practice with it, build some confidence, then move the rest of your funds. It's a part of participating in crypto is learning how to do that. 5 minutes away from the press conference, guys. We will be covering it off together, so do not go anywhere. Smash up the likes, and let's watch this press conference together. Right, let's see what you guys are saying. Mr. Got Plenty says, gang to you as well, my friend. Would the Fed hikes affect Asian markets when they wake up? Yep, the Asian markets will wake up, just like how I'm in the UK and I'm reacting to this as well. Asian markets will wake up and look at what's happened, but it won't have as big an effect as we're seeing now in terms of the volume. Billy says, steady, where's that gone? Steady growth gives more predictable chart analysis and better rate of returns. Yes. How long after the Fed pivot until the recession gets into full swing? Difficult to say, guys. I'm disappointed. I don't believe again, coming back to what somebody said previously, like, you can't trust the numbers. I feel like we're in recession already. They showed that we had a positive quarter. Don't be surprised if we have another negative quarter following. We'll just have to see how that plays out, but they're always smudging those numbers. What is your projection on the market's reaction to Powell's speech? I just got a feeling we're going to dump a little bit more. I've got a feeling we'll dump a little bit more. Hopefully we don't fall lower than 17,600. That'll be good. That'll be good news for me, is if we can close this conference out above 17,600, that'll be good. Bad is if we start falling into 17,000. Right? That's where I suspect. I can't think of what's he going to say to run us up to the upside unless he talks about 25 basis points. If he talks about 25 basis points, beautiful. Off we go. Right? And Jerome has done it a couple of times. We won't rule it out, right? He has done it a couple of times where he's managed to sweet talk the market. So he knows how to do it. It's just whether he chooses to do it or not. Micro Hayes, great advice. Don't wait and see. Yeah, no need to wait and see. Like, nobody's going to celebrate you for being like, oh, you trusted CZ. You're such a smart guy. Like, who's going to give you daps for that? Nobody. Right? Take it onto cold storage and keep it moving. Learn how to do it. I know why people don't do it. It's not like I'm arrogant to suggest that, oh, everybody's confident moving into cold storage. I know it's nerve-wracking. The first time I did it, super nerve-wracking, right? Like you're trying to think, okay, where do I put my seed phrase? How do I store it? Who do I give it to? But this is part of the learning and growing. When there's a moment where you need to learn and grow, do that. You know, what are your weaknesses? Is it self-custody? Is it tokenomics? Is it fundamental analysis? Is it technical analysis? And learn it. If it's TA, use my course down below. It's completely free. ijaz.uk/TA. Go use it, right? If it's learning how to trade, you'll learn that in that course as well. If it's other stuff, tokenomics, we've got loads of videos on tokenomics. I've made plenty of videos walking through how to do tokenomics. Go and watch them, right? Learn what your weaknesses are and start building on them. Don't just bury your head in the pillow. It doesn't work. Steve says Legend Nanos are pretty easy to use. Blessing says volume okay, man. Mr. God Plenty says take custody of your money. Celsius has some money and Genesis has some of my money too. Take custody of your funds. Yeah, really important, guys. Look, for those of you who it's their first bear market, a bear market is not about making money. A bear market is about holding onto your coins. If you leave the bear market and you've still got coins, you've won. It's not about, oh, what percentage did I get? Did I do some yield farming? Did I manage to put it into some, Celsius and get 5-6% in rewards? Nobody cares. You can do that in the bull market. There'll be returns everywhere, trust me. But in order to make it there, you've got to hold onto your coins. Do not get panicked out. The most common reason people leave is they get hacked or they lose their funds, whether it's through a hack, whether it's through an FTX, whether it's through a Celsius or a Do Kwon, and they fall out of love with crypto when it's got nothing to do with crypto. They're all centralized players. Crypto is decentralization. So learn that piece. Really important. Anova says 16,800 and I'm in on Bitcoin. Chosen One, Tangam is a pretty good hardware wallet. Lefty, 200 people and some likes. I think there's more likes than that. I think there was some more likes there. If there's not, guys, smash up the likes. What are you playing at? I find it funny how much power he has. All he has to do is say the number 25 and we moon. Yes, he's got a lot of power. Guys, he holds the money printer, right? All of this is based on the money printer. Let's not get confused. Stocks move when money is circulating in the environment. Stocks go down when you take money out of the environment. Very simple. You put too much money into the environment, you get inflation. You need to take money out of the environment. That's the situation we're in. Too much money came into the environment. Tesla went crazy. Bitcoin went crazy. Every altcoin went crazy. Everybody did a bunch of rug pulls and pumps and dumps. And now everybody is high on Red Bull. So guess what Jerome Powell has to do? He has to take the Red Bull off of the table. No more Red Bull for you. We've been irresponsible. We need to take it away. We need to sober up now, guys. We need to calm down. And that's why market's like, no, I want some more Red Bull. It was fun when we had Red Bull. That's where we're at. Right? Everybody's upset because they want that bull market back. But we were too irresponsible then. So we need to go for a little bit of a detox. And it'll be better for us when we get there. Martin says, I'm still here and holding. You're a legend, Martin. Martin Zabula, you've been here for ages. You have continued to hold and you continue to educate yourselves. There's people like you who do that, who do not get shaken out, that over the long run, you'll do well. Let's switch over to Jerome Powell. I can see him walking
and the hardship that high inflation is causing, and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Now for the Q&A, guys. That's always the boring bit of the statement. Fine, let's get some questions. This is what's going to move them on.
Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP again for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina. Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 0.75 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. and that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe, yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off. Other than the tech companies, which is a story unto itself, generally companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But, what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And, that will allow us to feel our way and, and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report,
nice try, you didn't answer it.
Do you think it would have changed some of those forecasts in today's SEP?
No, absolutely not. No, as a just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel? Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
It's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity
Markets are doing all right.
and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today, and as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
And we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see. We believe you need to see a better balancing of supply and demand in the labor market, so that you have. It's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running well above what would be consistent with 2% inflation.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate, and you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because...
And by the way, guys, that's the crux of it. The fact that in the SEP, there is no rate cut scheduled in for 2023. That's why markets are upset. But we're holding all right
for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Hi, Chris Rugaber, Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year, and this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline as long as new housing leases show declining inflation. That will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficiently restrictive. We laid out today what our best estimates are to get there. It boils down to how long do we think this process is going to take? And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but think we need to be honest with ourselves that there's, inflation, 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I mean, I would say this, to the extent we need to keep rates higher and keep them there for longer and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not. And if we do, whether it's going to be a deep one or not. It's not knowable. And certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a. So I would put it this way: of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Brian.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. We're certainly highly committed to do that.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time, that's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored, and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in the economy? Are you monitoring that?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low, where you're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking about getting Congress action on increasing legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned. If you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is, the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is. And that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Thanks, Jennifer.
Thank you, Chair Powell.
Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No. I mean, what we do is we make our forecasts and we publish them quarterly. And you know, if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just upside and downside scenarios. Of course, that's responsible practice.
I wish you would just stop now. We're doing all right. Just sitting shy of 18,000. We'll take that. Just stop, Jerome Powell.
We'll go to Jean for the last question.
Hi, Jean Young with Market News.
Last question, don't mess it up.
I wanted to ask about the SEP again. If you're reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course. That's something that we know and we'd see. But as I mentioned, we wouldn't. I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of for cutting rates. I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
That wraps up the news conference with Chairman Powell. That wraps up 2022 for the Federal Reserve. Live from New York City this afternoon. Good afternoon to...
Oh man, so there you have it, guys. Jerome Powell is done. He's done for 2022. And he pretty much tried to rug pull us. You can see markets here are not really too bothered, which is fantastic. We initially fell on the statement. We've managed to recoup some of that. Markets were just sideways pretty much for the whole press conference. You guys saw that. If we just kind of zoom out here, let's just put it onto the minute chart so you can see here. So if we put it onto the minute, you can see here 7:30 is when the press conference started my time. We were sideways for the whole time, and the market started moving a little bit here, just up a couple of $100 here, as he started to talk about the fact that there still is the possibility of this soft landing. So markets felt a little bit confident about this. They felt a little bit happy with some of his tonality, and we're pretty much where we started off, right? We didn't pump, we didn't dump. We're sitting pretty much where we were pre the FOMC meeting, but this time we've got 50 basis points in the pocket, we've got a pivot, and we've got a route to look forward to. So thank you guys for joining me on the live stream. What I will do now is I will do an 8 to 10 minute summary so you guys can come back and watch that, just explaining everything so you've got it in one place, so you can digest it in one place. So be sure to look out for that. Thank you for joining me on this live stream. Hopefully you guys found that useful. Make sure you smash up the likes on the way out. If you haven't, check out the links in the description. Make sure you're in our Discord, make sure you're in our Telegram, make sure you're following me on Twitter. You're in all these good places so you do not miss any of that. And if you guys are going to watch a football, go watch the football. And when the football's done, come back, watch the summary video, which I'll have up for you. Thanks for watching, guys, and I'll see you in the next one.